Hi everybody, Steve Griffiths here, developer of the MTPredictor software program. In today's MTPredictor video, I'd like to look at how the USE minis unfolded yesterday, which was the 22nd of February. In particular, I'd like to look at our TS3 buy setups here that unfolded around mid-morning. You see on the YM we had one, on the NQ there we get a TS3 buy setup, on the ES as well we had a TS3 buy setup. But because the market had gapped up, you can see here we had a very big gap. What happens with that is sometimes it can artificially inflate where the target is, because this is the last swing. Can you see that? There's the last swing that covers the gap. So what happens is when I place the analysis on, if I right mouse click here, do analysis, can you see how the target is a huge way away? It's a very, very long way away because it's based off the prior swing there that covers that gap. So is that really a sensible target to use? I mean, it would be nice if the market got up to that level and we had a nice 15-hour profit, but we have to be realistic. So what should you do when you get a artificially extended target like this on a gap up day like we had yesterday? Well, there's a couple of things we can do. First and foremost, you can use a closer target. So if I zoom in a bit, rather than using the target which is now way off the screen, I can come back here and say let's place a DP off the high early in the day. So off this high here, if we right mouse click, place a DP, you could then use that as a target. So if I now go out to where the previous target was, drag this down to here, this would now give us a target of about 3.8, 3.9R, a lot more realistic. So that could be an area to use there. Also, what you could do is have a look at the 24-hour chart at that same time as well, because obviously the 24-hour chart doesn't use gaps. The gaps are only there because we look at mainly our session times of 9:30 to 4:15, which is the US day session. So if I look at this same setup here on the 24-hour chart, which I've got here we go, we'll zoom in. Here's exactly the same setup, but as you can see, there's obviously market had traded beforehand. So there was data there, and you can see we actually put a swing low in, a pivot low in, just as the market was opening. So if I place the analysis off here, can you see how it now gives you a more realistic target? And actually, coincidentally, the target is in about the same place as we had on the previous chart. In fact, if I drag these two side by side, we can see exactly what we've got here. There we go. If I drag them side by side, can you see how there's the same setup and there's our target basically at about the same point as well. So in other words, that means that would be a more realistic target to use. And as you can see, the market did go up and reach that area where a nice either 3.8R or 3.9R profit was available. So I just thought this would be a good example to use or to look at when you get a target on your charts that have been sort of artificially extended by the gap up there. And again, if we look at the same thing on the NQ, let's place the DP off there, so that would be your target. So rather than 7.9R, that would be near a 4.6R profit. A very nice trade there on the NQ. And let's have a look at the ES, exactly the same. In fact, actually, you would have had a losing trade here. Let's have a look at the losing trade first. It's always important to know and understand and accept that every trading system will have losses. This is very important, so I'll say it again. It's always important to understand, know, and accept that every trading approach will have losses. But of course, we use correct position sizing, which varies the number of lots, contracts, or shares to keep your initial risk small and under control. In this case, less than 2% of a sample $20,000 account. So that means that when you actually had a losing trade here, it was what we call one risk unit. In other words, a minus 1R loss. So then when you come and do your analysis here, let's place the DP on there. You're a tick shy of that, but of course the other markets had reached their level. So let's be a bit more conservative here. So you hadn't quite reached your level. You may have actually, as we normally suggest, placed your order, MIT order, one tick below which you may have been filled at that high there, but let's be a little bit more conservative. It's always better to be conservative rather than over ambitious on these things, and say when you got to this level, knowing that these other markets had reached their levels as well, let's just trail at the 1 bar low. So you're 1 tick below the bar lows, and you've been stopped out there for a 2.5 hour profit. Either way, it would still have been a nice profit. But the most important thing is it would have been greater than that previous loss. So if that would have been a minus 1 hour loss, this would then be a plus 2.5 hour profit, and you'd have made money overall. Same kind of thing with this TS4 buy setup later in the day. We did the analysis here, didn't reach its target, but obviously really close to the end of the day. You may want to say once you get to that DP level, you then trail with the ATR stop, not the ATR stop, you trail at the 1 bar lows, which means you'd have come out there for a small profit as well, probably about half hour. But the whole idea of today's video is to show you that when you have an artificially high target like this, because of your gap open, then it's probably better to use a slightly closer target, perhaps the DP off the previous high, and also have a look at the 24-hour chart to see if that actually gives you a closer target as well, to be able to adjust your target into a more realistic level. And as you can see, we would have actually had some nice trades on the USE minis yesterday as a result of that.